This video is going to discuss the accounting for credit card receivables. Companies accept credit card payments from customers because they provide several advantages. First, the customer's credit is evaluated by the credit card issuer. That means the risks of extending credit are transferred to the credit card issuer instead of the company taking on the risk. A company's sales increase when they are willing and able to accept different payment options from customers, and cash collections from credit card companies are much quicker than if a company offers credit themselves. The accounting for credit cards is fairly simple and straightforward. With some credit cards and nearly all debit cards, merchants deposit the credit card sales receipts into the bank just like it deposits a customer's check. Historically, that's the way it was done. Today, with automatic drafts and EFTs, this is all done electronically. The deposit increases the merchant's balance in its checking account, typically the day of the sale. The negative for merchants is that they usually end up paying the bank or the credit card company a fee of somewhere between 1 to 5% of the sale on the credit card for the service of using the credit card. So let's take a look at an example when the company receives cash immediately on deposit. So if on July 16th, ABC has bank credit card sale of $500 to a customer. The bank charges ABC a 2% fee for the use of the credit card. ABC is receiving the cash immediately. ABC's revenues earned were $500. That was the amount of the sale made to the customer. But ABC's cash that they're receiving is really only $490 because 2% of the sale, or $500 times 2%, or $10, is given up and kept by the bank. So ABC will only receive $490, so we will debit cash for $490, and the $10 bank fee will become an expense of using a credit card. So we'll call that a credit card expense or a bank fee expense, some type of an expense. Sometimes, though, cash is not received immediately after the deposit. Companies will send their credit card sale receipts to the credit card company, and they will receive payment at some time after. So if on July 16th, ABC has credit card sales of $500 to a customer, the credit card company charges a 2% fee. Barton remits that credit card sale to the credit card company and has to wait for the payment on July 28th. On July 16th, the date of the sale, the revenues are recorded as earned. Credit sales $500. But instead of receiving cash, we have a receivable. This receivable is from the credit card company. So we will debit accounts receivable and then debit the credit card expense for the $10 fee. When that receivable is actually paid on the 28th by the credit card company, debited to cash, and decrease the accounts receivable from the credit card company.